Hi guys, welcome to today's tutorial. I hope you guys are having a good day. If it's still early in the morning, then I hope you're going to have a good day. So today we are going to be looking at assets. As promised, by the end of this lesson, you should be able to distinguish between current and non-current assets. You should also be able to record transactions that relate to assets, be able to understand what it means to debit an asset and what it means to credit an asset. So guys, welcome. Let's just dive straight into it. So, big question, what is an asset? An asset refers to resources owned and controlled by the entity as a result of past events or transactions from which future economic benefits are expected to flow to the entity. So in simple terms, assets are properties or rights owned by the business. So just to break this down for you in a simple manner, assets are: one, they are resources, right? They are resources. Let's just put this in bullet form. They are resources. Number two, owned and controlled by the entity, right? Number three, as a result of past transaction or events. So basically what this means is in order to acquire an asset or the rights of an asset, you need to I'd say purchase those assets. So when they say past events or transaction, that's what they're referring to. So as a result of past transactions and events from which future economic benefits are expected to flow into the entity. Right, so let's just take this right to the bottom. Right, okay, so what do they mean by future economic benefits expected to flow to the entity? Well, if you own something, you own it with the hope that one day you'll benefit from that, in this case, an asset. So that's what it means. You acquire those assets for future benefits. So if you break it down into these 4 bullet points, let me tell you, you can never go wrong. So what are assets? Explaining to your teacher now. I'm gonna try and go slower, but guys, please write this down and you will never go wrong. If ever your teacher asks you a question, what is an asset? First thing, it's a resource owned and controlled by the entity as a result of past transactions and events from which future economic benefits are expected to flow to the entity. Simple, just like that. So moving right along, what type of assets do we get? So number one, we have your current assets, and then number two, we have your non-current assets. So what's the difference between the two? Non-current assets are expected to be realized or consumed within 12 months or within your financial period, depending how long it is, but most common it's 12 months. And then your non-current assets, those are assets that are useful for a period longer than 12 months. So for example, you get your vehicles. Vehicles can be useful for a period longer than 12 months. I hope, if you're not reckless. So let's try and explain the difference between the two and what you get. Okay, it's simple. I'm gonna try and make this lesson short, but the most important thing is for you guys to understand what we're trying to teach here. So current assets, right, or current assets, like we said, they're expected to be realized or consumed within 12 months. So what type of current assets do we have? Guys, take notes. For one, you get your cash and cash equivalents. Number two, you get your receivables. Number three, you get your inventories. And then number 4, you get your prepaid expenses. There may be more to current assets, but in this video, we're only going to cover these 4, right? So when we talk about cash and cash equivalents, what exactly are we talking about? Just to put it in simple terms, it's money lying around in the business or money in the bank, but it is always money. So like you see here, 1, it's cash in the bank, and then number 2, you get your petty cash, and then number 3, you get your uncashed checks. So all of that will fall under your cash and cash equivalents. And then number 2, you get your receivables. So what are receivables? Number 1, that's your debtors. It's also known as your account receivables. Yes, so your debtors are also known as your account receivables. So those are the guys that owe the business money. So if you're selling your stock at on credit, those guys that owe you money, they fall under your assets, because in future they are going to be bringing you money. You get your accrued income. So accrued income is also it also is debtors, but it's different from debtors. But in common, what's common about them is that they are both assets. So accrued income is an income that you are expecting from someone, not necessarily your customer, but from someone you. For example, let's say we provide a service to someone and we're expecting them to pay us tomorrow. So they are not necessarily in our debtors book, but they still owe us money. So that money is accrued. And then examples, you get your rent receivable, interest receivable, and last but very important, your allowance for bad debts. So your allowance for bad debts is known as your negative asset, but it's still an asset. So your allowance for bad debts is actually deductible from your debtors, but we will explain that when we get to your accruals, chapters of accrual. I will cover your allowance for bad debts, as well as when we study your account receivables. Yes, still gonna be fun. There's still a long way to go, but for now, let's just briefly go through your current assets. And then number 3, you get your inventories. So when we speak of inventories, what are we talking about? We're talking about your stock that is held for sale. Very, very important. But also we have your stationery. You can also have your stationery. So your stock that you have in your business for sale is stock that's going to bring you money. And like we said, it is assets are transactions from past events from which future economic benefits are expected to flow into the entity. Exactly what's going to happen here. Now that you have your stock that is purchased and is held in your warehouse, you are expected to sell the stock and gain money from it. So that is your asset. And your stationery is also falls under your inventories. So that's your number 3. And then number 4, your prepaid expenses, guys. Prepaid expenses, basically that's stuff that we pay for before acquiring the service. So for example, let's say we are renting a building, but we're only going to start using the building in the following month, but we've already paid for the building. Maybe it was to get the space, maybe it was in demand, so just to make sure we have the place, we already paid for the next 5 months, even though we're only going to start using the building in the following month. So that's called your prepaid expenses. It is an asset. Your insurance, same example. Let's say we already paid for the full year, even though we're still at the beginning of the year, but we already paid our insurance for the full year. That's called your prepaid expenses. So everything, every service or every asset that you acquire and you pay before getting the service or getting the asset falls under your prepaid expenses. So I hope you guys understand, and most importantly, all of this is expected to be consumed or realized in the space of 12 months. Don't worry guys, we will go through transactions and everything on how you record assets or transaction in assets, right? But moving on to your non-current assets, there's a second type of assets we get, your non-current assets. So just a brief explanation or a recap. Your non-current assets are assets that are expected to be useful for a period longer than 12 months. So what are we talking about here? We're talking about your land. Common, but not all the time. You're gonna find your land and buildings together, but in this case we're just gonna separate the two because it's not a must for them to be together. So you get your land. Number 2, you get your buildings. Number 3, your equipment, your long-term investments, and also your intangibles. So what are all these, right? Land area owned for business operation. So basically, if you have your buildings, basically we're hoping you have your buildings on your own land. So the value of your land will, what's nice about the land and buildings, that your value of your land will always appreciate, but in some cases buildings do depreciate. So you get your land. Land is considered an asset, but not just an asset, a non-current asset, because it is expected that it will be with you for a period longer than 12 months. And then you get your buildings, such as your office, factory, warehouse, or even your stores. That's also considered non-current assets, because you won't have a building today and then tomorrow the building is gone unless you sell it. But in this case, we're expecting that since this is our headquarters, we're going to keep our buildings for a period longer than 12 months. And then number 3, you get your equipment. So equipment includes machinery, furniture, as well as your office equipment, etc. And these are all the stuff that you as a business need for day-to-day operations. And it is your asset, non-current asset, because as it says here, your machinery, furniture, for a wise business, you'll never buy something that you know will be dead or broken within a year. You'll buy something that you know is an investment for over a year, and you're still going to have that, and it's still going to be useful. And next, you have your long-term investments, right? Your long-term investments, basically, it's an investment. So we're speaking about financial investments here. For example, your fixed deposit. That's the most common investment for businesses. But just bear in mind, it's your financial investments, but not just any financial investment. A financial investment that is there or going to be there for a period longer than 12 months. If it's below 12 months, then it will fall under your current assets. So it's very important for you to know the difference between non-current and current assets. And then you get your intangibles. Intangibles, basically here we're talking about non-physical assets, such as your goodwill, your patent, your copyright, your trademark. So for big businesses that are trading, for example, Nike, that's an asset to them. Their label, their brand, that's an asset to them. Even though it's not an asset like land and building, it's still an asset, and it does have a value. Whenever Nike decides to sell Nike, let me tell you, they'll make huge money from it, but I doubt they will. So that's it for today, guys. Next chapter, or no, not next chapter, next video, we're gonna record transactions for assets and everything. So we're just gonna go a bit deep into the subject, but for today, just a recap, guys. Assets, they are resources owned and controlled by the entity as a result of past events from which future economic benefits are expected to flow, right? And you get 2 types of assets, your current assets as well as your non-current. What's the difference between the two? Current assets are expected to be realized or consumed within 12 months. And your non-current assets, they are useful for a period longer than 12 months. And for examples of those, your current assets, you get your cash and cash equivalents, receivables, inventory, prepaid expenses. Your non-current assets, you get your land and buildings, equipment, long-term investments, as well as your intangibles. So guys, thank you very much for tuning in. Please come back for the next video. We're gonna go through the rest. Enjoy your day. Bye bye.